Okay, let's unpack this. Have you ever found yourself wondering about those S-corp you hear whispers about in the business world? They kind of sound like a secret club, maybe with some pretty sweet tax perks right here. Well, today we're pulling back the curtain. We're taking a deep dive into the advanced strategies, the intricate rules, really what makes S corporations such a fascinating and sometimes, yeah, tricky beast in the tax jungle. Our mission in this deep dive is pretty simple. Take these complex financial concepts, specifically around S corporations, and just break them down. Make them clear, understandable insights for you, our curious listener. We've got quite a stack of detailed sources to get through, and we're here to give you the ultimate shortcut to being well-informed.
And what's truly fascinating here, I think, is how seemingly small details in these rules can have really significant financial implications for business owners. We're here to connect those dots for you, help you understand not just what these rules are, but, why they matter to your bottom line.
All right, let's set the stage then. What exactly is an S corporation? At its core, an S corp is what they call a flow-through entity. Think of it like this.
Yeah.
All the income, gains, losses, deductions. Everything the business generates doesn't get taxed at the corporate level first. Instead, it just flows through directly to the shareholders.
Right.
This means that you, as an individual owner, you're taxed on your proportionate share of those earnings. And this is key, regardless of whether you actually receive cash distributions.
Exactly. That's a fundamental difference from, say, traditional C corporations, where profits get hit twice, once at the corporate level, and then again when distributed.
Okay, so how does a company become an S corp?
Well, it's crucial to understand that when a corporation is first formed, it automatically defaults to being taxed as a C corporation. That's the default. It only gets S corporation status for tax purposes if a valid S corporation election is properly filed with the IRS. And importantly, when you contribute assets, property, to this new corporation in exchange for stock, the initial calculation of any gain or loss realized and recognized is handled in exactly the same way as it would be for a C corp.
Ah, okay, so that brings us directly to a really crucial starting point for any S corp owner. Property contributions. You might think, oh, S-Corp flow through like partnerships, so it's all simple, right?
Not always, no.
Even though S-Corp offer many tax advantages similar to partnerships, some S-Corporation traits remain exactly the same as for C-corporations. The taxability of shareholder contributions, for instance, that falls under Section 351 of the tax code, just like C-Corp.
Right.
This means a contribution is generally considered non-taxable, only if it meets three very specific conditions. First, it has to be a contribution of actual property, not just, say, services you performed.
Okay.
Second, it's solely in exchange for stock, no other cash or other goodies involved.
Mm-hmm.
And third, and this is a big one, after the transfer, the shareholder or the group of shareholders making the transfer together has to control the corporation. And control here means at least 80% stock ownership.
And if those requirements aren't met, it's a big deal. The contribution is then treated basically as a taxable sale, meaning any gain the fair market value you received over your basis in the assets gets recognized and taxed immediately.
Ouch.
Yeah. And a key takeaway here for anyone starting an S-Corp, meeting those Section 351 requirements, it's generally much easier when you're first forming the S-Corporation. It can become significantly harder to meet that 80% control requirement if you're making later property contributions as an individual shareholder, or maybe if new shareholders come on board down the line.
Okay, that makes sense. And what about basis? That's always important.
Absolutely. So the S-Corporation's basis in any property you contribute is simply the same as your original adjusted basis in that property, a carryover basis.
Got it.
As for your initial stock basis as a shareholder, it's a pretty straightforward calculation. It's the cash you put in plus the adjusted basis of any property you contributed,
Okay.
reduced by any liabilities the corporation assumes from you. It also includes the fair market value of any services you might have contributed in exchange for stock.
And later contributions.
Right. Any subsequent non-taxable property contributions you make under Section 351 will also increase that shareholder's stock basis.
Okay, so we've laid out the rules, but how does this actually impact you, the listener? Let's throw a real-world scenario at it. Imagine Ray contributes property. Its fair market value is $20,000, and his adjusted basis in it was $10,000. He exchanges this for stock in an existing S corporation. Let's call it Falcon Corporation. Immediately after this transfer, Ray only owns 20% of Falcon stock. So the big question is, what happens to Ray from a tax perspective? Gain or loss? His stock basis, Falcon's basis in the property.
This is a perfect illustration of why that 80% control rule in Section 351 is so vital. Ray has a $10,000 realized gain. That's just the math. $20,000 fair market value minus his $10,000 basis.
Okay.
But crucially, because Ray didn't have 80% or more ownership in Falcon right after the exchange, he must recognize that $10,000 gain.
So it's taxable immediately.
It becomes a taxable event for him right away, yes.
Yeah.
His stock basis then becomes $20,000. That's his original $10,000 carryover basis from the property, plus the $10,000 gain he just recognized.
Right.
And Falcon's basis in the property it received also steps up to $20,000. So the key takeaway from Section 351 for ongoing S-Corp, if you're contributing property and don't meet that 80% control threshold, prepare for potentially immediate, maybe unexpected taxable gains.
Wow, okay. That 80% rule is incredibly important then. Let's consider another angle, though. Property contributions where the corporation takes on debt. Imagine Roberts. He contributes property with an adjusted basis of $100,000 and a fair market value of $200,000. This is in exchange for 100% of a newly formed S corporation. Let's stick with Falcon Corporation. Falcon also assumed a $70,000 mortgage that was on the property Roberts contributed. The fair market value of Roberts' new Falcon stock is $130,000. So what's Roberts' gain, his stock basis, and Falcon's property basis in this situation?
Okay, here, Roberts realizes a $30,000 gain. That's the property's $200,000 FMV minus the $70,000 debt Falcon took, minus his original $100,000 basis. So $30,000 realized gain.
But is it recognized?
But here's the good news. No gain is recognized.
Okay, why the difference from Ray's scenario?
Because Roberts met all the Section 351 requirements. It was a property for stock, solely stock, no boot.
And he had control.
And he owned 100% of the stock immediately after. Plus, a critical point. The debt assumed by the corporation, the $70,000, did not exceed his adjusted basis in the property, which was $100,000. That's important.
Okay, so what's his basis in the stock?
His stock basis is $30,000. That's his $100,000 basis in the property contributed, reduced by the $70,000 debt the corporation assumed.
And the corporation's basis in the property?
That stays at Roberts' original basis of $100,000. It's a perfect illustration of how Section 351, when you navigate it properly, can let you do these transfers tax-free. So we've established that S corporations generally avoid corporate-level tax, which, is a huge benefit.
Right, that's the main draw for many.
However, there are 3 specific situations where they do actually pay taxes directly at the corporate level. This happens primarily if the S corporation was previously taxed as a C corporation. This is a really key area to understand because it can significantly impact the overall tax bill for the business and its shareholders.
Absolutely. Let's break those down. The first type of corporate-level tax we need to talk about is the LIFO recapture tax. This specifically hits C corporations that elect S status, and we're using the LIFO inventory method. Last in, first out. What happens is, in their very last year as a C corp, they have to include in their taxable income the excess of their FIFO inventory value, first in, first out, over their LIFO value.
So they have to recognize that difference.
Exactly. The resulting tax from that income in the final C Corp year can be paid in 4 equal annual installments. The first payment is due with that final C Corp return. The remaining 3. They're actually paid by the S corporation itself, even though it's technically a C Corp tax liability.
Okay, interesting. Moving on, there's the built-in gains tax, usually called the big tax.
Yeah, this one sounds important.
It is. It can arise when a C corporation elects S status. And at that specific election date, the fair market value of its assets is higher than their adjusted basis. We call that difference an unrealized built-in gain.
Makes sense.
Now, if those specific assets are later sold or disposed of within a certain time frame generally, it's 5 years from the S election date. The S corporation itself might have to pay tax on that built-in gain.
Are there ways around it? Exemptions?
Yes, there are a few scenarios where an S corp is exempt. For example, if it was never a C corp to begin with, or if the sale happens after that 5-year recognition period. Also, if the S corp can definitively prove the appreciation in value happened after the S election, or if the asset itself was acquired after the S election, then the big tax wouldn't apply to that specific asset.
Okay. So what does this all mean for you, the listener? Let's illustrate how the big tax actually kicks in. Can you walk us through an example, maybe with Hyde Corp?
Sure. Okay, Hyde Corp was a C corporation, and then it elected S status effective January 1, year 3. At that moment of conversion, it had a net unrealized built-in gain of $15,000, mostly tied up in its inventory. Then, in year 4, Hidecore sold that specific inventory. At the time of the sale, that inventory had a $25,000 built-in gain attached to it. Also, just for context, Hyde's taxable income in year 4, calculated as if it were still a C Corp, would have been $100,000. So the question is, how much big tax does Hidecore actually pay in year 4?
Okay, the tax here is $3,150. Here's how we get there. The big tax is calculated at the current C Corp tax rate, which is 21%. But, and this is key, it's applied to the lesser of 3 specific figures.
Get a minimum of 3 amounts.
Exactly.
Yep.
First, there's the actual recognized built-in gain on the sale, which was $25,000 in this case.
Yeah.
Second, there's the total net unrealized built-in gain at the time of the S election, which was $15,000 for Hyde. And third, there's the S Corp's taxable income calculated as if it were a C corporation, which was $100,000. So you take the smallest of those 3 numbers, $25,000, $15,000, or $100,000. The lowest is $15,000. Then 21% of that $15,000 is $3,150. This example really shows vividly how that prior C Corp status can absolutely follow an S Corp and lead to, unexpected taxes right on the corporation itself.
Absolutely. And the third type of corporate level tax is the tax on passive investment income. This tax, also at that 21% rate, is imposed on an S Corp only if 2 conditions are met. First, it must have accumulated earnings and profits from its prior C Corporation days. C Corp EMP.
Oh, okay.
And second, its passive investment income, think royalties, dividends, interest, rents, annuities, must exceed 25% of its total gross receipts for the year.
Both conditions have to be met.
Both conditions. It's important to remember, if an S Corp has never been a C Corp, or if it doesn't have any C Corp EMP left, this tax doesn't apply to them no matter how much passive income they generate.
Got it. Okay, now let's shift focus. We've talked about the corporation, but let's look at your perspective as a shareholder. Ultimately, an S Corp is about that flow through to you. So how do the income, the losses, the contributions, how do they directly impact your personal stake in your tax picture? It really all starts with understanding your basis, doesn't it?
That's exactly right. Understanding your shareholder stock basis calculation is absolutely critical. It's the foundation because it dictates how much loss you can deduct and also how any distributions you receive are taxed. You start with your initial stock basis. That includes any cash you put in, the adjusted basis of property you contributed.
Like we discussed earlier.
Right. And the fair market value of any services you might have contributed for stock. Then, as the S Corp operates year to year, you add any additional contributions you make. And you add all income items that flow through to you. That's the ordinary business income, any separately stated income or gains, and even tax-exempt income increases your basis.
Okay, increases. What about decreases?
Good question. From that total, you subtract any cash distributions you receive. You also subtract certain non-deductible expenses and, of course, any loss or deduction items that flow through to you. And the final figure, after all those ups and downs, is your ending basis in your S Corporation stock for that year.
Now, it's important to differentiate that from what we call shareholder debt basis, right?
Yes, very important distinction. Unlike partnerships, S Corp shareholders do not get to include any of the S Corporation's external debts, say, a loan the S Corp took from a bank in their stock basis calculation.
Okay.
However, if you, the shareholder, make a direct loan from your personal funds to the S Corporation, that creates a separate basis for you. We call that debt basis.
And that matters for losses.
It matters hugely for losses, as we'll see. What's also key is that neither your stock basis nor your debt basis can ever go below 0. There's a floor. This floor affects both the pass-through of S Corporation losses and the tax treatment of any distributions you might receive. Let's say put these basis calculations into practice. Make it real for you, the listener. Imagine Don. He's a 10% shareholder in Cowan Corp, a calendar year S Corporation. At the end of year 1, his stock basis was recorded at $60,000. Now, in year 2, the S Corporation had ordinary business income of $200,000. It also had separately stated interest income of $5,000 and separately stated charitable contributions of $15,000.
Okay.
During year 2, Don received total cash distributions from the corporation amounting to $25,000. And one more thing. Don personally loaned Cowan Corp $50,000 at the beginning of year 2. During the year, Cowan repaid $10,000 of that loan principal to Don.
Got it. So given all that activity, what's Don's stock basis and his debt basis at the end of year 2?
Okay.
Let's break it down. Don's stock basis ends up at $54,000. We start with a $60,000 beginning basis. Then we add his share of the income items. He's a 10% owner, so 10% of the $200,000 ordinary income is $20,000.
Right.
And 10% of the $5,000 interest income is $500.
Right. Basis goes up.
So far, $60,000 plus $20,000 plus $500 equals $80,500. Then we subtract the things that reduce basis. The $25,000 cash distribution he received comes out, and his 10% share of the $15,000 charitable contributions, which is $1,500, also reduces basis. So $80,500 minus $25,000 minus $1,500 leaves his stock basis at $54,000. Now, for the debt basis,
Right, the loan he made.
he started by loaning the corp $50,000. The corp repaid $10,000.
Yeah.
So his debt basis ends up at $40,000, $50,000 minus $10,000.
Precisely.
This example really shows clearly how all these different pieces, income, expenses, distributions, loans, flow through and directly impact both your stock basis and your separate debt basis.
Precisely.
Okay, moving on to a really critical topic for S-Corp shareholders, the limitations on pass-through of losses. If your S-Corp has a loss for the year, you can't just automatically deduct it all on your personal tax return. It's not that simple.
No, definitely not.
There are actually 4 potential hurdles you must clear, and they have to be cleared in this specific order to deduct that loss. First is tax basis. Second is at risk. Third is passive activity loss, or PAL. And fourth is the excess business loss limitation.
4 hurdles.
Right. And it's important to remember that the first 2 tax basis and at-risk limitations are generally applied at the entity level, meaning they look at your direct financial stake in this specific S-Corp.
Okay.
The PAL and excess business loss hurdles, however, those are applied at the individual level on your overall Form 1040, looking across all your activities.
Got it. So let's focus on the tax basis limitation first. A loss from the S-Corp can only flow through to you and be deducted on your return to the extent of your total tax basis in that S-Corp. And total tax basis here means your stock basis plus the basis of any direct loans you've personally made to the S-Corporation.
So stock basis plus debt basis.
Exactly. Any losses that are in excess of this combined basis are suspended. They're essentially put on hold. They wait until your tax basis is reinstated in future years.
And how does basis get reinstated?
By any of the things that normally increase basis, future income or gains flowing through from the S-Corp, or you making additional capital contributions. When basis is reinstated, there's an order. It rebuilds your debt basis first, back up to its original amount, and then any remainder increases your stock basis.
Interesting order.
Yes.
Yeah.
A suspended loss due to insufficient tax basis can be carried forward indefinitely, just waiting for that basis to reappear. However, a crucial point. If you sell or dispose of your S-Corporation stock while you still have these suspended losses hanging around due to lack of basis, those losses are generally lost forever. You can't deduct them later.
Wow. Okay. Good to know. So that's tax basis. What about the second hurdle, the at-risk limitation? This sounds similar, but how is it different?
It is similar in concept, but it's specifically designed to limit the loss you can deduct to the amount of actual financial risk you have in the business, basically, your skin in the game, how much you personally stand to lose. While your at-risk amount is often the same as your combined stock and debt basis, here's a key difference. Let's say you, as a shareholder, take out a non-recourse loan, meaning you're not personally liable for repayment, and then you use those borrowed funds to make a contribution or loan to the S-Corp. That specific amount is included in your tax basis calculation.
Not at risk.
But it's not included in your at-risk amount. Why? Because you're not personally on the hook for that non-recourse debt. The lender bears the risk.
Ah, okay. That makes sense.
A loss that gets stopped by the at-risk rules is also suspended and carried forward indefinitely. Interestingly, though, any suspended at-risk losses remaining when you eventually dispose of your stock can generally be used to offset any gain you might recognize from selling that stock. Slightly different treatment than basis suspended losses there.
Okay. Subtle differences.
To give you a super clear illustration of at-risk versus tax basis, let's consider Gertie, an S-Corporation shareholder. He contributed $12,000 in cash and also land that had a basis to him of $25,000. So far, so good. He also loaned the S-Corporation $15,000. But here's the catch. Gertie had borrowed that $15,000 from another source on a non-recourse basis. He wasn't personally liable.
Yeah.
His pro rata share of S-Corporation income for the year, which was undistributed, was $10,000. So let's calculate. Gertie's stock basis is $47,000. That's the $12,000 cash plus $25,000 land basis plus $10,000 undistributed income.
Right.
He also has a $15,000 debt basis for the loan he made to the X-Corporation. This makes his total tax basis $62,000, $47K stock plus $15K debt.
But the loan was non-recourse.
Exactly. Because that $15,000 loan was funded by non-recourse borrowing, where Gertie isn't personally liable, it's not included in his at-risk amount. So Gertie's at-risk amount is only $47,000, which is just his stock basis in this case. This is a crucial distinction. His tax basis is $62K, but his at-risk basis is only $47K. That difference can directly impact his ability to deduct losses beyond $47,000.
That's a fantastic clarification. Okay, here's an example that I think really brings all these basis rules and loss limitations together. Let's talk about Anna and her S corporation tax basis limitation. At the end of year 1, Anna's stock basis in her S corporation stock is $30,000. She also loaned the S corporation $10,000 from her personal savings back in year 1, so she has debt basis too.
Okay, $30K stock, $10 debt, total basis $40K.
Right. Now, in year 2, the S corporation incurred an ordinary business loss, and Anna's share of that loss was $75,000. Then, in year 3, things turned around. Her share of ordinary business income was $50,000. Assume no other changes to Anna's stock basis, and the S-Corp didn't make any payments on the loan from Anna in years 2 and 3. So the big question, how much loss or income actually flows through to Anna's tax return each year, and what's her basis situation at the end of year 2 and year 3?
This is a great workout of the rules. Okay, for year 2, Anna has a $75,000 loss share, but her total basis is only $40,000. 30K stock plus $10 debt. So she can only deduct $40,000 of that loss on her individual tax return for year 2.
And her basis?
That $40,000 deductible loss wipes out her basis. It reduces the basis of both her stock and her debt to 0 by the end of year 2.
What happens to the rest of the loss, the $35,000 difference?
The remaining $35,000 loss, $75K, $40K, is suspended due to lack of basis. It just waits for her tax basis to be reinstated.
Okay, now moving to year 3. She has $50,000 of income share.
Right. That $50,000 ordinary business income flows through and is taxed on Anna's individual income tax return for year 3. No question there. But first, that income has a job to do regarding her basis. It needs to reinstate her basis. Remember the ordering rule, debt basis first.
Oh, right.
So the first $10,000 of that income goes to reinstate her debt basis back up to its original $10,000 amount. The remaining $40,000 of income then increases her stock basis. So now her stock basis is $40,000.
And now that she has basis again.
Exactly. Now that her basis is restored, 10K debt plus 40K stock equals 50K total. That suspended $35,000 loss from year 2 can finally flow through. It gets deducted on her year 3 income tax return.
Okay, so what's her final basis at the end of year 3?
Her stock basis ends up at $5,000. That's the $40,000 increase from the income minus the $35,000 suspended loss that just flowed through. Her debt basis remains at the $10,000 it was restored to. So her total tax basis at the end of year 3 is $15,000. $5,000 stock basis plus $10,000 debt basis.
Wow. That clearly illustrates the whole cycle. Loss suspension, basis wipeout, income restoration, and finally using the suspended loss. Complex.
It really is. And it also highlights why tracking both stock and debt basis separately is so important. It's also important to understand how income and losses are actually allocated among all the shareholders, especially if ownership changes during the year.
Yeah, how does that work?
Well, like partnerships, S corporations flow through their ordinary business income or loss, and all those separately stated items we mentioned, gains, losses, deductions to the shareholders. But the key mechanism here is how it's divided up. Allocations to shareholders are made on a per share per day basis.
Per share per day.
Exactly. This ensures fairness and accuracy, even if someone buys or sells shares mid-year.
Let's see that in action with another quick example. Duffy Corp is an S-Corp, calendar year, owned equally by 3 shareholders, Rick, Tim, and Peter, 1/3 each. On February 1st of year 5, Peter sells his entire 1/3 interest in Duffy Corporation to a new person, George. The total ordinary business income for all of year 5 was $120,000. Let's assume no separately stated items just to keep it simple. So how is that $120,000 income allocated to each of these 4 people for tax purposes?
This per share per day method makes the allocation very precise. For year 5, Rick and Tim, they each own 1/3 for the entire 365 days. So they each simply get $40,000 of income allocated to them, $120,000 total by 13. Straightforward.
Okay.
Now for Peter, he owned his 1/3 share for only 31 days, all of January, so he gets a pro rata share of what would have been his $40,000 annual share. It's $40,000 times 31 days, 365 days. That comes out to $3,207 allocated to Peter.
Got it. And
George then owned that same 1/3 share for the remaining 334 days of the year, Feb 1st to December 31st. So he gets his pro rata share, $40,000 times 334 days, 365 days, which equals $36,603 allocated to George. You see how it works? It ensures the income is split accurately based on exactly when each person owned the shares.
Yeah, that highlights the importance of that per-day allocation method. Gets the numbers just right. And just to quickly recap some of those common separately stated items that flow through from an S corp onto your personal K1, similar to a partnership. We're talking about things like net rental real estate income or loss, interest income, dividend income,
All
royalties.
the gains and losses.
Right, net short-term and long-term capital gains or losses. Section 1231, gains or losses, charitable contributions. The Section 179, expense deduction.
All pass through separately.
These all get reported separately to you, the shareholder, on your Schedule K1, so you can treat them correctly on your own return.
And don't forget Section 199A, the qualified business income, or QBI, deduction.
Oh yeah, that's a big one potentially.
It can be. It's a potentially powerful tool. Might give you up to a 20% deduction as a below-the-line deduction on your 1040 against the ordinary business income that flows through from the S corporation to your individual tax return. Now, the specific rules for qualifying for it are pretty intricate. They can vary based on your income level, the type of business.
Right, it's not automatic.
Not automatic, no. But just know it's a crucial potential benefit for many S Corp owners that you'll definitely want to explore, probably with your tax advisor.
Good point. Okay, to properly track all of this complex income and distribution activity, especially for distributions, F corporations use two key internal accounting buckets. There's the Accumulated Adjustments Account, or AAA, and the Other Adjustments Account, OAA. Let's start with AAA.
Okay.
Think of the Accumulated Adjustments Account, AAA, like the S-Corp's running scorecard of taxable profits since it became an S-Corp. It specifically tracks all the accumulated S-Corp earnings that you, the shareholder, have already been taxed on because they flowed through to you.
So it represents previously taxed income.
Yeah. Exactly. Yeah. So when distributions come out of AAA, they're generally tax-free to you because the IRS, in theory, already got their share when the income was earned. Distributions generally won't reduce AAA below zero, but losses can make the AAA balance go negative. What increases AAA? Generally ordinary business income and most of those separately stated income and gain items we just talked about. But notably, not tax-exempt income. That doesn't go into AAA.
Okay. And decreases?
Decreases come from ordinary business losses, separately stated losses and deductions, certain non-deductible expenses, again, excluding expenses related to tax-exempt income, and of course, distributions made to shareholders.
Got it. So that's AAA. What about the OAA, Other Adjustments Account?
Right, the OAA. This one is designed basically to keep a cumulative record of items that affect your stock basis as an S corporation shareholder but don't belong in the AAA.
Like what? Primarily things like tax-exempt income, such as interest on municipal bonds and any related expenses. Also, tax-exempt life insurance proceeds. It can also track federal taxes paid or accrued in an S corporation year that actually relate back to prior C corporation years.
Does OAA affect distribution taxes?
Generally, no. It's important to note that the OAA usually doesn't directly affect the taxability of S corporation distributions. Its main role is really just in managing the reconciliation of your stock basis.
Okay, AAA is the key one for distributions, though.
For the most part, yes. Especially the order of distributions. So when it comes to non-liquidating distributions, meaning money or property flowing out to shareholders while the S-Corp is still operating, the general rule is good news. They're usually not taxable to shareholders.
Because we already paid tax when the income flowed through, right?
Yeah, exactly. As we discussed, you, the shareholder, have generally already been taxed on that underlying income when it passed through on your K-1 each year. However, and this is a critical however, this simple rule changes if an S corporation has prior C corporation earnings and profits, or ENP, lingering from before it became an S corp.
Ah, that C corp history again.
Yes. In that specific scenario, distributions can become taxable even if they come from the S corp.
Okay, so let's break down the rules clearly. First, the simpler case. S corp that have no C corporation ENP. Maybe they've always been an S corp.
Right.
In this straightforward scenario, there's a clear hierarchy, kind of like layers, for how distributions are treated. First layer. Distributions come out of the S corporation's AAA, up to whatever its balance is. These are not subject to tax and simply reduce your basis in the stock because, again, the underlying profits were already taxed.
Makes sense. Layer 1, AAA, tax-free reduction of basis.
Second layer. If the AAA is completely emptied out, distributions then come to the extent of the S corporation's OAA balance. Again, these are not subject to tax and they reduce your basis in stock, as they typically represent things like prior non-taxable income.
Layer 2. OAA, also tax-free reduction of basis.
Third layer. If both AAA and OAA are depleted, any further distributions are treated as a return of capital, but only up to the amount of your remaining stock basis. Still not subject to tax at this point, but they further reduce your stock basis, potentially down to zero.
Layer 3, return of basis, tax-free reduction of basis.
Finally, the fourth layer. Anything you receive in excess of your stock basis at this point, after basis hits zero, that's taxed as a capital gain. Usually long-term capital gain, assuming you've held the stock for more than a year.
Layer 4, excess over basis, taxed as capital gain. Okay, that's clear. Let's use a quick example to illustrate this simpler case. Feline Corporation. It's been an S-Corp since day one, so no C-Corp E&P. Let's say it has a zero balance in its AAA prior to making a distribution. Carlin, a shareholder, has an $18,000 stock basis after accounting for all the year's income and loss, but before considering the distribution. He receives a $22,000 cash distribution during the year. How is it taxed?
Okay, since there's no AAA and no C-Corp E&P, we skip right past those layers. The distribution first counts as a return of capital up to his basis.
Right.
So the first $18,000 to $22,000 distribution is a non-taxable return of capital. This reduces his stock basis down to zero.
Right. Yeah.
The remaining $4,000, $22,000 received, $18,000 return of basis is in excess of his stock basis. So that $4,000 is taxed to Carlin as a long-term capital gain.
Pretty straightforward when there's no C-Corp E&P in the mix.
Exactly. Now let's tackle the more complex scenario. S-Corp with C Corporation E&P. This is where that history matters.
Right. The hierarchy here gets modified because of that additional, potentially taxable layer of C-Corp earnings.
Okay, walk us through the layers now.
Layer 1 is the same. Distributions come first to the extent of the S-Corp AAA balance. Still non-taxable, still reduces stock basis.
Okay.
Then layer 2, and this is the crucial difference, distributions come to the extent of any remaining C Corporation E&P.
And this part is taxable.
This amount is taxable as a dividend to you, the shareholder, and importantly, receiving a dividend distribution does not reduce your stock basis.
Okay. Taxable dividend, no basis reduction. Got it.
Layer 3, after the C Corp E&P is exhausted, then distributions come to the extent of the S Corp OAA, back to being non-taxable, and it reduces stock basis.
Layer 4.
Layer 4 is return of capital, just like before. To the extent of any remaining stock basis, it's a non-taxable reduction of basis.
Yeah, layer 5.
And finally, layer 5. Anything beyond all that, after basis is zero, is taxed as a long-term capital gain.
Wow, okay. That E&P layer really changes things.
It absolutely does. Let's unpack this with a real-world scenario for you, the listener. New Elect Corporation. It was a C Corp for years, then elected S status on January 1, year 2. When it converted, New Elect had accumulated C Corporation E&P of $20,000. Now fast forward. From year 2 through year 8 as an S Corp, New Elect had total ordinary business income of $100,000 and had made total shareholder distributions of $60,000. This left its AAA balance at $40,000. $100K income, $60K distributions.
Okay, $40K AAA, $20K C Corp E&P.
Exactly. Now, in year 9, New Elect has ordinary business income of $50,000, and it makes total distributions to its shareholders of $120,000.
Yeah.
So what's the tax result of that big $120,000 distribution in year 9?
Okay, let's follow the layers for core with E&P. First, distributions come from AAA. The AAA balance was $40,000 at the start of year 9, plus the $50,000 of current year income increases it. So there's $90,000 available in AAA. The first $90,000 of the $120,000 distribution comes from AAA. This $90,000 is non-taxable to the shareholders because it represents income already taxed to them. It reduces their basis. Now, we still have $30,000 of the distribution left, $120K, $90K. What's next?
Next layer is the C Corporation E&P. New Elect had $20,000 of that.
So the next $20,000 of the distribution comes from that C Corp E&P. And this $20,000 is a taxable dividend to the shareholders.
Correct. Taxable dividend,
Right.
and it does not reduce their stock basis.
Okay, so that's $90 from AAA plus $20K from E&P equals $110K distributed so far. We still have $10,000 left of the $120K distribution.
Right. What's the next layer after E&P?
After E&P comes OAA, then return of basis. Let's assume OAA is zero, just for simplicity. So the next layer is return of stock basis. That excess $10,000 is then a non-taxable reduction in the shareholder's stock basis, assuming they have at least $10,000 of basis left. If the distribution had been even larger, say $130,000, and they only had $10,000 of basis left, that final $10,000 beyond basis would be a taxable long-term capital gain. This example clearly shows the significant impact that having that prior C Corp E&P layer has on how distributions get taxed. That dividend piece is key.
Absolutely.
This leads us to a fascinating strategic move that S Corp with prior C Corp E&P can sometimes make. The election to bypass AAA.
An election.
Yeah. An S corporation can actually choose or elect for a specific year to treat distributions to shareholders as coming first from its prior C corporation accumulated earnings and profits instead of draining the AAA first. It flips the first two layers.
Huh. Why would they want to do that? Treat distributions as taxable dividends first.
Well, one common reason is to proactively get rid of that C Corp E&P balance. Remember that passive investment income tax we talked about? It only applies if you have C Corp E&P. So fleshing out the E&P can help avoid S status termination down the road if the company anticipates having a lot of passive income.
Strategic E&P management.
Exactly. Another reason might be if it's simply a good tax year for the shareholders personally to receive dividend income, maybe they happen to be in unusually low individual tax brackets that year.
Okay, interesting planning tool. Let's illustrate this bypass election. Martin Corp is an S Corp. At the end of year 2, before any distributions, it has $100,000 in its AAA and $20,000 in C Corp E&P. Terry is the sole shareholder. His stock basis before the distribution is $75,000. Martin Corp makes a $50,000 cash distribution to Terry in year 2, and importantly, elects to bypass AAA for these distributions for year 2.
Okay, so they flip the switch. Bypass AAA is on.
Later.
Because of this bypass election, the normal distribution order changes. The first $20,000 of the $50,000 distribution is treated as coming directly from the C Corp E&P. That means this first $20,000 is taxable dividend income to Terry. And crucially, this dividend portion does not reduce Terry's stock basis.
Yep.
The remaining $30,000 of the distribution, $50K total, $20K E&P, then comes from the next available layer, which would normally be AAA. This $30,000 is a non-taxable return of basis, and it does reduce Terry's stock basis.
So what's his ending basis?
Terry's ending stock basis after the distribution is $45,000. That's his $75,000 starting basis, minus only the $30,000 from AAA. The $20K dividend didn't touch basis. This demonstrates a specific tax planning tool that can be really useful, especially for managing that tricky E&P balance and its consequences.
Good example.
Now, let's consider one more twist on distributions. Non-liquidating property distributions. What happens when an S Corp distributes property, maybe a piece of equipment or some land, or even a building instead of just cash?
Okay, property instead of cash.
The amount of the distribution is simply the fair market value FMV of that property at the date it's distributed. That part's easy. But the tax treatment for the S corporation itself gets interesting. Here's a really key point. The S corp recognizes a gain on the distribution of appreciated property. It's treated as if the S corp had sold that property for its fair market value right before distributing it.
So the S Corp has a gain.
Yes. And that gain then flows through to you, the individual shareholders, on your K1s, in the same way as any other S corporation operating gains. Increases your basis, potentially taxed to you.
Okay. What about property that's gone down in value? Depreciated property.
Crucially, an S Corp does not recognize a loss on the distribution of depreciated property to its shareholders. The loss just vanishes at the corporate level.
No loss recognition for the S Corp on depreciated property. That's important.
Very important for planning. Also, the S Corp's AAA and/or its accumulated E&P, if any, is reduced by the fair market value of the property distributed, regardless of basis. Now, for your tax treatment as the shareholder receiving the property, first, you recognize your share of that flowed-through gain, if any, from the S Corp distributing appreciated property. That increases your stock basis.
Okay.
Then your stock basis is decreased by the full fair market value of the property distributed. And finally, your basis in the actual property you receive is its fair market value at the date of distribution.
Got it. Let's maybe explain this with a dual impact example. Show both appreciated and depreciated property distributions happening at the same time. Mills Corp is an S Corp, always has been. It has Zoe and Brody as equal 50% shareholders. Going into the distribution, each has a $200,000 stock basis. Mills Corp's ending year 4 AAA balance before distributions is $400,000. In year 4, Zoe and Brody each receive a distribution of property. Each piece of property has a fair market value of $150,000.
Okay, equal value distributed.
But the basis is different. The property distributed to Zoe had an adjusted basis to Mills Corp of only $30,000, so highly appreciated. The property distributed to Brody had an adjusted basis to Mills Corp of $180,000, so this one was depreciated worth less than its basis.
Okay, same FMV, different basis. How does this play out? First, for Mills Corp itself, it recognizes the $120,000 gain on Zoe's appreciated property. That's the $150,000 FMV minus the $30,000 adjusted basis.
And that gain flows through.
Right. That $120,000 gain then flows through $60,000 to Zoe and $60,000 to Brody, which increases each of their stock bases before we account for the distribution itself. However, And this is that significant point for tax planning nil score, is not allowed to recognize the $30,000 loss on Brody's depreciated property, the $150,000 MV minus the $180,000 adjusted basis. That loss just disappears for the corporation.
So distributing depreciated property is generally bad if you want to recognize a loss.
Exactly. If your goal as an S-corp is to recognize a loss, simply distributing depreciated property is usually not the way to do it because the corporation loses the ability to ever recognize that loss. Better to sell it, recognize the loss, and distribute the cash.
Good tip. Okay, what about the shareholder's final basis?
All right. So Zoe and Brody each started with $200,000 basis. Each got a $60,000 gain allocation from Zoe's property, bringing basis up to $260,000. Then, each received property worth $150,000 FMV. That distribution reduces their basis. So both shareholders' ending stock basis is $110,000, $260,000 minus $150,000. And their basis in the actual property they now hold, that's $150,000 each, which was its fair market value when they received it.
Perfect. Shows both sides clearly.
Okay, now we reach the final stage, really, of the S-corp journey. Termination and liquidation. Sometimes the S-corp status ends. What causes an S-election to actually terminate?
Well, there are a few distinct ways this can happen. First, it could be a voluntary revocation. Shareholders holding more than 50% of the stock that includes both voting and non-voting shares can simply agree to revoke the S election.
Yeah, they can choose to end it.
Second, the corporation could simply fail to meet one of the S status qualifications we talked about earlier. Maybe it accidentally issues stock to more than 100 shareholders or to an ineligible shareholder like a corporation or a partnership. That would terminate the election. Yeah.
Involuntarily.
Right. And third, there's that excess passive investment income rule again. If an S-corp has passive investment income exceeding 25% of its gross receipts for 3 consecutive years, and it also has prior C corporation E&P from its C-corp days, then its S election terminates. Both conditions must be met for 3 years straight.
Okay. And when does the termination actually take effect? Does it vary?
Yes, the effective date of termination can vary quite a bit. When a majority of shareholders elect to voluntarily revoke, they can actually specify an effective date for the termination. If they don't specify a date and they file the revocation paperwork by March 15th of the year, the revocation is effective retroactively to January 1st of that same current year.
Oh, retroactive.
Yes, if they file it after March 15th and don't specify a date, the effective date is January 1st of the following year.
Okay. What about involuntary termination?
If the corporation fails to meet any of the S-corp requirements, say, by issuing stock to an ineligible shareholder like a partnership, the S-corporation status is terminated immediately on the date it fails the requirement.
Instantaneous.
Pretty much. And for that excess passive income rule we just mentioned, 3 years over 25% passive income plus C-corp E&P, the S-corporation status is terminated automatically at the beginning of the 4th year.
Got it. Now, termination of an S election can lead to something called short tax years, right?
That's right. The tax year in which the termination occurs can actually be split into 2 distinct shorter tax periods. You end up with an S corporation short year, the part of the year before termination, and a C corporation short year, the part of the year after termination.
When does this split happen?
This happens if the corporation revokes the election mid-year and specifies an effective date, or if it involuntarily fails to meet one of the requirements for S status mid-year. The corporation then faces a choice. It must allocate its total income or loss for that entire calendar year between these 2 short periods.
How do they allocate it?
They have 2 main options. Option 1 is simpler. Allocate based on the relative number of days in each short period. Pro rata daily allocation. Option 2 is more precise but requires more work, formally closing the books on the exact date of the conversion. This means precisely tallying up all income and expenses earned or incurred up to the termination date for the S period and doing the same for the C period after that date.
Can you show us how those allocation methods might differ?
Sure. Let's use ArriveCorp. It's a calendar year S-corp, and its S status was involuntarily terminated effective April 1st, year 3. So termination happened mid-year. ArriveCorp's actual income and loss before and after the termination was known. It had an S corporation year 3 loss of $20,000, specifically for the period January 1st through March 31st. That's 90 days. Then it had C corporation year 3 income of $120,000, specifically for the period April 1st through December 31st. That's 275 days. The total net income for the entire year 3 was therefore $100,000, $120K income, $20K loss.
Okay, so how is that $100,000 total income allocated using both methods? All right, if they allocate based on the relative number of days method, The total $100,000 income for the entire year is split proportionally based on days. The S-Corp short period gets $24,658 allocated to it, $100,000 total income by 90 days, 365 days. The C-Corp short period gets the remaining $75,342 allocated to it, $100,000 total income by 275 days, 365 days.
Even though the S period actually had a loss.
Right. The daily method just smears the total result across the year. However, if they elect the closing the books method on the date of conversion, April 1st, then the actual results are used. The S-Corp short period reports the actual loss of $20,000, and the C-Corp short period reports the actual income of $120,000. This really highlights the flexibility and the potential tax impact of choosing an allocation method. Closing the books reflects reality, but daily allocation might be easier or sometimes more favorable depending on when income losses occurred.
Good point. And just a quick note on re-electing S status after termination. Generally, once an S corporation election has been terminated, the corporation, or its successor, usually must wait until the beginning of the 5th year after the year of termination before it can elect S corporation status again.
So a 5-year waiting period, typically.
Typically, yes. It's not an immediate restart button.
Okay. And finally, at the very end of the line, liquidation of an S corporation. What happens when the whole thing dissolves?
This is generally treated very similarly to how the liquidation of a C corporation is treated, with a few S corp twists.
Okay. Consequences for the S corporation itself first.
In a liquidating distribution, the S corporation is treated as if it sold all its distributed assets at their fair market value right before the distribution. So the corporation itself will recognize gain or loss on the distributed property.
Unlike non-liquidating distributions, losses can be recognized here.
Yes. Generally, losses can be recognized by the S corp in a liquidation, as if the property were sold. However, there's catch. Distributions made to related parties, like a controlling shareholder, generally do not qualify for loss recognition at the corporate level, even in liquidation.
Related party rule. Okay. What about the shareholders?
For you, the shareholders, any distributions received from an S corporation in a complete liquidation are treated as payments received in exchange for your stock, like selling your stock back to the dissolving company.
So capital gain or loss treatment.
Exactly. You would calculate your gain or loss by taking the amount you realize that's any cash, plus the fair market value of any property you received, minus any corporate liabilities you personally assumed, and subtracting your final adjusted stock basis.
And how is that final stock basis calculated?
Crucially, your stock basis for this liquidation calculation is determined after all of the S corporation's other activity for its final year has been taken into account. This includes your share of any final operating income or loss, and importantly, your share of any gains or losses the S corp itself recognized on distributing its assets in liquidation. Those flow through first and adjust your basis before you calculate your personal gain or loss on the liquidation distribution itself.
Okay, basis adjusted first, and the character of the gain loss.
The character of your gain or loss recognized, capital versus ordinary, will depend on whether the stock was a capital asset in your hands and how long you held it, long-term or short-term, and your basis in any property you receive in the liquidation. That's simply its fair market value at the date of distribution. Let's maybe close this section with a comprehensive liquidation example that ties all these final pieces together. XYZ Corp is an S Corp. It makes a final liquidating distribution of its only asset, a building, to its sole shareholder, W. The building has a fair market value of $100,000 and an adjusted basis to XYZ Corp of $60,000. XYZ Corp also had $10,000 of ordinary business income during its final year before the liquidation. W's basis in his XYZ stock was $30,000 at the beginning of that final year. So what are the tax consequences of this liquidating distribution for both XYZ Corporation and its sole shareholder, W?
Okay, let's break it down. First, for XYZ Corp itself, it's treated as selling the building for FMV. So XYZ recognizes a $40,000 gain on the distribution of the buildings as the $100,000 FMV minus the $60,000 basis.
Right, corporate level gain.
This $40,000 gain, recognized by XYZ Corp, then flows through to shareholder W, just like all S Corp income does. Now, let's look at shareholder W. His beginning stock basis was $30,000. We first have to adjust his basis for the final year's activity before the distribution. That includes the $10,000 of ordinary income and that $40,000 flow-through gain from XYZ's deemed sale of the building.
So basis goes up first.
Right. $30,000 plus $10,000 plus $40,000 brings W's stock basis up to $80,000 immediately before calculating his gain on the liquidating distribution itself. Then we calculate his personal gain on the liquidation.
Mm.
He received the building worth $100,000 FMV. So his gain is $20,000. That's the $100,000 fair market value of the building he received minus his final $80,000 adjusted stock basis.
$20,000 capital gain for W on.
Exactly. This final example really shows the full circle. Corporate level gain recognition flowing through, adjusting shareholder basis, and then shareholder level gain recognition on the actual liquidation.
Oh.
Wow. Okay, we really took a deep dive today, didn't we, into this fascinating and, yeah, surprisingly complex world of S corporations. From getting assets into the company tax efficiently to navigating those corporate level taxes that can sometimes pop up.
Like the big tax or passive income tax.
Right. To understanding your personal basis calculation, stock versus debt, navigating those tricky loss limitations.
Four hurdles.
Handling distributions, both with and without that C Corp E&P history. And even what happens when an S Corp eventually ends through termination or liquidation. It's really clear that these entities offer incredible flexibility, but wow, they absolutely demand a thorough understanding of their unique tax landscape.
Indeed. And what's truly fascinating here, I think, is how seemingly granular tax rules, like the ones we walk through in these examples, have very real, very direct financial impacts on the shareholders. Understanding these mechanics isn't just academic, it's key to effectively leveraging the advantages of being an S corporation, or, just as importantly, avoiding potential pitfalls and surprise tax bills.
So what does this all mean for you, listening right now? Whether you were maybe thinking about forming an S Corp or you're already a shareholder in one, really grasping these advanced topics empowers you. It helps you make more informed decisions. It's about more than just, crunching numbers. It's about strategic financial planning that can directly impact your wealth and your business's success.
Absolutely. And this raises, I think, an important question for you to maybe ponder after this. Given the specific rules we discussed today, especially thinking about property contributions, those basis rules, and the distribution rules, how might you strategically time certain transactions? Could you structure things differently to optimize your tax outcome or maybe avoid some of those unexpected liabilities we highlighted? When is the best time to contribute that appreciated property versus maybe selling it first? Things like that.
That's a fantastic thought to leave with. Definitely some strategic planning involved.
Yeah.
Well, thank you for joining us on this deep dive into S Corp. Until next time, keep that curiosity alive.